means for U.S. equities as well. Let's welcome Bill Baruch of Bloomberg Futures into the conversation. Bill, more disappointing data, but I guess we probably anticipated much of it. The market reaction broadly kind of neutral. Nevertheless, the U.S. curve over the last few days has continued to flatten up. The message coming from the rates market is actually things are not okay. Yet equity markets aren't saying that. What is your read, A, of the data, and B, of how that's being priced into different markets?
Well, there's two things here that have stood out the most to me. First, when you had the rip higher in equity markets last week, treasuries were they moved lower, but very shallow. And looking at the 30-year bond, it was a very shallow push lower, and ultimately that's set up for the next leg higher that's developing right now in the 30-year bond, which is going to flatten the curve. I like treasuries. I like the 30. I'm long the 10s and the 30 through a number of strategies that we use. But additionally, you look at the market broadly, it's only a handful of stocks really pushing equities higher. It's Amazon, Netflix, got some healthcare that's doing it. Amazon, I mean, is just amazing seeing what that stock has been able to do. But the entire market, the S&P 500, will not be able to track just Amazon. So I think the treasuries are giving us a signal that there's some weakness to come here in the equity markets. Yep. And I would like the 30-year to leg up one more time.
Aside from the 30-year, where do you see the best risk-reward right now?
In the Treasury curve, where I see the best risk-reward, this morning our trade program,
more broadly, I kind of not just in the Treasury curve, more broadly across assets.
Well, I actually like the Treasury curve. I like being long the 30, and our program that's up 13.9% this year actually got long the 10-year today through an option strategy. I think there is some upside here in the immediate term as well as the intermediate term and the 10s and the 30s. Additionally, if you've been long equities, there are places to reduce some risk. I think it's smart to reduce some risk in equities at these elevated levels. And then on top of that, crude oil is also on my radar. We're seeing that crude oil curve flatten out a bit. The May contract, which is going off the board, you have options expiration today in May. The $20 strike has 11,000 open interest. That's keeping a floor in the May contract. What I've been looking for is June to close that spread. June is weaker. It's down about 50 cents, where May's up 40 cents. I'm looking for a target to the downside in June, about 23.5 on the June crude oil contract.
It's fascinating. OPEC saying that it sees demand for its crude dropping to the lowest level